Today we're talking about income tax bracket planning as it relates to Roth conversions. So for people who are in their 60s, 70s, some in their 50s that have substantial amount of money in their IRA and they haven't paid any tax on that yet, and they're anticipating retirement, and they come in asking us about Roth conversions. And so when we get to the income tax section, one thing you don't want to do is do a big, huge Roth conversion all at one time. Is take $1 million in an IRA and just move it all into a Roth all in 1 year. I mean, it's just going to put you in the highest tax brackets possible, and it's going to eat up a significant chunk. So what makes a lot more sense is to do it in pieces over time and perhaps not do all of it. I mean, you're going to want to leave some money in a traditional IRA for a number of reasons, but most people, and what I've done with mine personally, is I have the lion's share of it is converted, so I'll enjoy tax-free income in retirement at my discretion, and then when I pass away, it'll go to my wife, or when she passes away, it'll go to our children, and all of that'll happen is they can enjoy the money without having a tax lien on it. So what we're talking about today is really bracket planning, and what I've got up here is what we use, not the whole of what we use, to plan Roth conversions. So if you have a single person, what we're going to do is let's use an example of somebody who's 64 years old, they're single, and they're making $80,000 a year, okay? And they've got a substantial IRA because they've been a good saver. Maybe they made more money than that in the past, but they're making 80 grand a year right now, and they're not retiring for a few years, and they're thinking, I'd like to look at these Roth conversions, and I'd like to consider them, and how much should I convert? And so the math is pretty simple, that we could take 80,000, of which they wouldn't pay 24% tax, they'd be paying 22% tax on some of it, and we could convert $90,000, or we could bring their adjusted gross income up to $170,000, and on the last money, we would be paying taxes at a rate of federal taxes at a rate of 24%. So that's the number for them that we would start out with is $90,000. Now, that doesn't mean everybody that is in that situation is going to convert 90, but if a 24% federal tax rate is acceptable to them, then the most that we would want to do is $90,000 in any 1 year. And then if perhaps they wanted to convert more and they were looking at a 32% rate that was acceptable to them, and they had substantial money in their IRA, well, then we could do another $45,000, $46,000, and we would pay 32% federal tax rate on that additional $40-some thousand. So we put all this in the software and calculate what the taxes are, and then we'd have to add to that, if you're in a state that has an income tax, then we'd have to add that in as well. So that's for a single person. For a married couple, the example that I'm going to use is a married couple, same age, both 64, or one's 64 and the other one's 60 or 61, 62, and they have an income of $160,000, and they can convert $180,000 of either IRA, if they both have an IRA, or a 401k. If the money's in a 401k, they're going to have to roll it into a regular IRA and then do the conversion, and we can help you with that. But in any case, that would be the top 340 grand of adjusted gross income would be the top of the 24% bracket. And then the same thing holds true is that if 180,000 of conversion, they wanted to bite off more than that, then we could get an additional 90,000 converted in this year and pay the 32% federal rate. Now, one thing that's going to come to mind is whenever we're planning this and doing it year by year by year, we're planning is, first of all, are we going to do this or not? I mean, that's what people hire us for, is to help them make that decision. It's either a yes or a no. And does it make sense to pay taxes now at what, at least historically, are some pretty good rates? And, are we going to do that now, and are we going to bite the bullet now and pay the taxes, and that money's gone, so that we can enjoy tax-free income later? Are we going to do that or not? And then once we decide, yeah, I think we want to do that, then we got to decide how much per year and for how long. And it doesn't mean we have to implement every piece of the strategy when we come. We really have to decide, if you're coming into us now, is how much we're going to do in 2022 and then plan 23 and so on and so forth. We can make some adjustments as we go along. The thing I want to emphasize is the lost opportunity. Like, if you just look at this and you say, yeah, I'd like to do it, and then you're just kind of stuck in decision-making mode, and all of a sudden 2022 is gone, and then now it's 23 or 24, and you're looking at this again. Once January 1st, 2023 rolls around, you've lost the opportunity to convert however much at the 24% rate. So there's an opportunity cost here, or if you converted less than the maximum of the 24% rate, and then the year passes, that's the thing that's lost. And these rates are scheduled to go up in 2026. So when the Tax Cuts and Jobs Act was passed in 2017, started in 2018, it lasts for 10 years. Okay, and in 2026, actually, that's only 8 years. So in any case, in 2026, the rates are scheduled in the current law to go up and go back to what they were before 2018. So this is something that we know what the rates are, and we feel pretty confident they're going to stay at this level for the next 4 years. So this is an opportunity that you ought to take a look at. Now, the second point here is you'll need to decide, are you going to pay the income taxes due out of other money that you have sitting on the sidelines? Or if you don't have the luxury of that, you just don't have other money on the sidelines, but you still want to do the Roth conversion. Like if we use the example of the person doing 90 grand, the single person, ideally we'd like them to pay the $25,000 in taxes that are due in this conversion out of other money. But if they don't have the other money to do that, we're going to pay it out of the IRA money, and then they're going to be left with only $65,000 starting out in the Roth, because they've spent $25,000 of it on taxes. So it's a more ideal situation to pay it out of other money, but a lot of people don't have that luxury. It still can make sense to do it paying the taxes out of the money. Now, I've just talked about people in their 60s. I'll talk about people 50s and 40s for a second, because my assistant asked me, preparing for this, is this available to people that are younger? And you can do Roth conversions. It's just you can't use the money in the IRA to pay the taxes. If you do, that'll be a distribution, and in addition to the tax, you'll have to pay a 10% penalty, and that's just unacceptable. So the only way you can do this under 59 and a half and take advantage of this is to have the money on the sidelines to pay the taxes. And again, I don't encourage borrowing money to do this. So now we're going to talk about people that are in their 70s and 80s. And used to, you couldn't take or do a Roth conversion once required minimum distribution started. But the Secure Act got rid of that. So you can do Roth conversions for the rest of your life. What happens is once you're 72 and you have to do required minimum distributions out of a taxable IRA or a pre-tax IRA, you have to take a minimum distribution in that year. You can't convert the amount of that minimum distribution. you have to take that and pay the taxes. But on amounts above that, you absolutely can convert it. And so we have many people doing these in their 70s and 80s. And then you want to think about, you can convert a lot more or pay lower taxes while you're filing a married and joint return. So the people in their 80s, a lot of times we're dealing with a widower, and they didn't really think about the survivor living on, whether they do Roth conversions or not. They're going to be a single taxpayer, so they're going to pay at higher rates, or they're going to have lower brackets, however you want to look at it. But this makes sense in the 70s. It absolutely makes sense. And I've done this with a lot of my IRA money. Now, why are we wanting to do this? Why does this make sense? Because it's counterintuitive to pay taxes now that we could avoid. I mean, you've been avoiding them your whole life or postponing them through, and that's the beauty of an IRA. And now all of a sudden you got this crazy guy on a video telling you, no, now we're going to turn this thing into a tax-free account, so we're going to pay the taxes now. Well, why would you want to do that? Well, it's incurring pain now for something that's going to be better later on. Again, number one is tax-free growth, is that, you know, if we took the example of the $90,000 and we moved it over on that single person, well, now they got $90,000 over in the Roth, maybe more later, but that $90,000 can be invested in the same thing that it was when it was in the taxable IRA or the pre-tax IRA. So same investments, and presumably it's going to grow and grow substantially, and you're never going to pay any tax on that growth, or your heirs are not going to pay tax. So you're going to get tax-free growth. You'll have the opportunity to get tax-free income in the later part of your retirement. That's what I'm after, because when I'm drawing a Social Security check, and my wife is after 70, you know, if you'll remember from some of my other lessons, Social Security is taxed to the extent of your other income. So what I want my other income to be is coming from a tax-free source, or a lot from a tax-free source. So I'll have that money tax-free, and I'll also have the Social Security tax-free. You know, things aren't going to work out as perfect as I'm saying, but that's the general idea, is the ability to get tax-free income. And, you know, I talk a good game now, and clients talk a good game, but I'm going to tell you what's really going to happen is, as people get into their 70s and their 80s, other than healthcare and long-term care, they spend less. And, you know, I have a lot of them as clients, and I know them very well, and they live off of their Social Security checks, some interest, some IRA withdrawals. I mean, it's just, and, you know, this whole idea of the tax-free income, you know, sounds great, but when you're 80 years old, you don't really want to go out spending a bunch of money. And so what really ends up happening to this IRA money is it ends up being left to the next generation. And that's where the real payoff is with Roth IRAs, because it you know, your kids, I mean, your IRA, if it's taxable and you got a large balance in there and you're successful at growing it and then just taking the minimum, and you're, you know, it's like it has a mortgage on it. You know, I heard it referred to as tax invested. I mean, it's just, you've got a silent partner, and it's the IRS, and they're silent, they're quiet, they're patient, because they're going to take 40, 50% of that thing, especially if it's all drawn out in 1 year. And so they're fine to wait for their money. And the real reason to do that is to do this intelligently now at low rates, so that you can enjoy an account that grows tax-free, you can withdraw tax-free, and you can leave it in your estate tax-free for your kids to enjoy. I'm Hans Scheil, and I thank you for listening.